News about GameStop and Tesla stock is super exciting and what's usually covered, but most people are investing in boring funds through their 401k. And since information on those funds isn't covered in the media, it can be really hard to understand what the fuck your 401k options are. I mean, when I first started contributing to a 401k, I had no idea how to understand the information they were presenting to me about these funds or what ones I was supposed to pick. So to help demystify all of the information surrounding the funds you're offered in your 401k, I'm going to break down everything you need to know to pick good 401k investments so you can make as much money as possible. The first thing you need to know about your 401k is that you are investing for the long term. I'm talking decades. And they're so serious about this that they actually charge you a 10% penalty if you withdraw your money before the age of 59 and a half. The good news is that it's a piece of cake to make money if you are invested for a long time. And that's because historically the stock market has always gone up over time. So if you invest for several decades, you're pretty much guaranteed to make money. To make the big bucks, there are two key things you need to focus on when deciding what to invest in your 401k. And the first is to reduce your risk by investing in a diversified set of assets. And the second is to reduce your fees as much as possible. So now that you know that your goal is to do these two things in your 401k, you need to know what to look for in your fund's descriptions so that you can reduce your fees and reduce your risk. The number one thing you should look at is the expense ratio. High expense ratios are your enemy. A fund's expense ratio tells you how much they charge to cover their administrative expenses. So the higher the expense ratio, the more you're going to end up paying in fees. When going through your 401k investment options, try to stick to funds that have an expense ratio of 0.5% or lower. Many funds have expense ratios of 0.1% or lower, and that's ideal. Those high fee funds are going to try to tempt you to choose them though. Usually funds with high expense ratios are actively managed, and that means that the fund manager hand selects stocks that they think are going to outperform the market and provide a higher return for their investors. Now remember, the market goes up over the long term and in general usually provides investors with a positive return. These actively managed funds say that they're going to give you returns even higher than the ones that the general market can give you, which is what tempts investors to pay these higher fees. Unfortunately, most of these funds fail. A whopping 68% of actively managed funds underperform the market. So that means that they provide a return that's even less than the general market return, and they charge higher fees, which means you're making less money and paying more in fees, which is a terrible spot to be in. Luckily, passive funds have much lower expense ratios because they just track an underlying set of investments and try to get the same return as the market. So since a fund manager doesn't have to go through and do all of the extensive analysis that's required to try and beat the market, then they can keep their administrative expenses much lower, which means a lower expense ratio for you. So by investing in passive funds, you're going to make a higher return and pay less in fees, which is a great deal. The second thing you should look for when reviewing your funds is the market capitalization of the companies that the fund holds. A company's market capitalization, or market cap, is the value of all of its outstanding shares of stock. Large cap companies are usually worth over 10 billion, mid cap are worth between 2 and 10 billion, and small cap are worth less than 2 billion. It's important to consider a company or fund's market cap when choosing your investments because as a company's market cap increases, its risk decreases and vice versa. Large cap companies tend to be lower risk because they're usually market leaders in their sector and have been around for a long time and are well established and pretty predictable. Mid cap companies, on the other hand, are typically in a growth phase, and so therefore their future is a little less predictable, so they're a little bit riskier. But this increased risk also means that there's the potential that they could provide their investors with higher returns than large cap stocks. Small cap companies are considered the riskiest because they're usually in their infancy or are in emerging or niche markets. If you're a risk taker, you can include more funds that contain small to mid cap companies. And if you're more risk averse, then you can opt to only include funds in your portfolio that contain large cap companies and reduce your risk. The third thing that you should consider is the market sector that the fund covers. Simply put, a market sector is a part of the economy. Some funds contain companies spanning many market sectors, and others contain companies in a singular market sector, like technology or retail. Some funds also will include international companies, while others will only be composed of domestic companies. It's important to consider the diversity of market sectors in your portfolio, again because of risk. The more market sectors you're invested in, the less risky your portfolio, and the fewer market sectors you're invested in, the riskier your portfolio. That's because when you're invested in a broad range of market sectors, if one is performing poorly, the other sectors can help offset the negative effect that that poor performing sector is having on your portfolio. Limiting your investments to one sector or only a couple of sectors exposes you to a lot more risk, because if one of them starts performing poorly, you could see much higher losses. So now that you understand how to go through each fund and evaluate it, you need to understand how to put them together into your portfolio to make a great comprehensive portfolio that will give you the return you're looking for at a risk level that you're comfortable with. To do that, you need to understand asset allocation, which is an investment strategy that seeks to balance a portfolio to match an investor's risk tolerance. To do this, you put each asset into the portfolio at a certain percentage. This allows an investor to increase their percentage of risky investments if they're seeking a higher return, or to decrease their percentage of risky investments if they're more risk averse. In general, it's recommended that you reduce the risk of your portfolio as you age, but everyone's risk tolerance is different. Overall, stocks are considered riskier than bonds, and international investments are considered riskier than domestic ones. If you're young and more of a risk taker, you can invest more heavily in stocks and international investments, and if you're older and more risk averse, you can invest more heavily in bonds. So a great way to build a diversified portfolio and easily manipulate the asset allocation in there is to use a 3-fund portfolio structure. It's a super popular portfolio structure because it allows you to quickly put together a well-diversified portfolio and easily manage your risk within the portfolio. To build this type of portfolio, you use 3 index funds: a US stock fund, an international stock fund, and a US bond fund. Once you've chosen your 3 funds using the criteria that we discussed earlier, then you can manipulate the percentage you have invested in each of those funds based on your risk tolerance. If you want a riskier portfolio, you can invest 80 to 90% of your money into the stock funds and only 10 to 20% in the bond fund. And if you want to have a less risky portfolio, then you can invest more heavily in bonds and invest a smaller percentage in the domestic and international stock funds. The beauty of this type of portfolio is that it is super simple and can easily be tailored to meet almost any investor's needs. If all of this still sounds super overwhelming to you and you are just totally lost, no worries. Target date funds are for you. These funds do all of the work for you, and they determine your asset allocation based on your retirement date. Then they automatically go in and invest in these funds for you at the percentage that they recommend. That means that you can just choose one target date fund to invest in and still get exposure to both domestic and international stocks and bonds. Another great thing about these is that they also will reduce your risk over time. So as we said earlier, as you near retirement, it's recommended that you reduce the risk of your portfolio, and target date funds will go in and manipulate your asset allocation as you near your retirement date and make sure that base is covered for you also. So if you're here now, then you have done all of the heavy lifting and you now have this amazing 401k that is well diversified and has low fees. So you've done most of the work, but you do still need to manage your portfolio. I'd recommend going in and adjusting your asset allocation about once a year. And that's because over the course of a year, your asset allocation can get a little out of whack. Let's say that you began the year 90% invested in stocks and 10% invested in bonds. If stocks had a super great year that year, then you may find at the end of the year that your stock percentage is actually a little bit higher than you'd like it to be. So you can go back in and sell off some of your stock holdings and increase your bond holdings to get your percentages back to that 90-10 level. And you might be thinking, like, why would I do that if stocks are performing so well? But remember that the asset allocation that you chose is based on your risk tolerance. And so you're going to want to maintain that risk level if that's what you're comfortable with. Again, if this sounds like too much work for you, target date funds are your go-to because they also do this step for you. So target date funds not only will set up your portfolio structure and allocate your assets in the way that they recommend and do all of that for you, but they will also make sure that as time goes on, you're maintaining that asset allocation so it's never going to get out of whack. So if you want to do the lazy thing and be invested in a well-diversified portfolio, target date funds are an excellent option. So, I mean, I get it. It can be super easy to get overwhelmed when trying to decide what investments you should choose for your 401k, but luckily there are only a couple of things that you need to know to be able to choose great investments. You need to keep your expense ratios low, manage your portfolio's risk by diversifying your investments, and build a portfolio that will give you the highest return possible at a risk level that you're comfortable with. And I mean, if all of that is too complicated at the end of the day, there's always a target date fund. Thank you so much for joining me today, you guys. If this video helped you understand how to choose your 401k investment so you can make the most money possible, please make sure to give this video a thumbs up because I want to be a rich bitch just as much as you, and it helps me with the algorithm. I release a new video every Saturday that talks about wealth building, investing, and how to become a rich bitch. So if that is something that you are interested in, please make sure to subscribe to my channel, and I will see you next week. Bye!